Good afternoon and welcome to the lecture 13 of ETC 779. In this lecture, we are going to cover different aspects of depreciation and taxes which impact our decision as far as alternative selection is concerned. So, basically we will have focus on depreciation and tax considerations in evaluation of alternatives. Whatever discussion we have had till this time, we had concentrated only on pre-tax cash flows. That means, we had not considered any tax consideration as far as our evaluation of alternatives were concerned. So, we had assumed that there is no tax consideration, whereas in real life situation you will find that whenever companies make profit, they have to pay certain taxes. Similarly, companies are also allowed to get rebate on the expenses that they incur. Not all the expenses are liable for tax exemption. However, there are select expenditures, select expenses which are eligible for tax rebate. So, we will find out how does depreciation as well as taxes come into picture while evaluating alternatives. So, this particular lecture we will be concentrating on a brief discussion on depreciation. I am sure you must be familiar of different ways of calculating depreciation. You must be aware of a straight line method of depreciation, sum of years digit method of depreciation, double declining balance method. These are some of the methods that we will be discussing briefly, and then we will show how do they impact our alternative selection. So, in this particular lecture, I will explain you how to draw post tax cash flow diagram. How to draw post tax cash flow diagrams. Till now, we have not considered taxes, and so all those cash flow diagrams you can term it as pre-tax cash flow diagrams. Okay, if you see this particular slide, you can notice that there are different taxation rules followed in different countries, right. Even within the same country, you will find that there could be different tax laws in different states. So, in order to understand the implication of taxation on your decision making, you should be familiar with the tax structure that is followed in your country. So, one of the assignment that you can do could be to be aware of the taxation prevailing in Ethiopia. You must find out how much taxes construction companies have to pay on their gross income. So, just inquire from your local construction industry how much taxes they have to pay on their gross income. For our exercise purpose, we will assume a flat rate of 35% to 40% on the gross income. That means, the tax rate we will be considering would vary between 35% to 40%. In your country, you can find it out what is the tax rate. That means, how much tax a construction company has to pay to the government, right. This is given to you as an exercise, right. Now, these tax laws or these tax rules are subjected to frequent changes. So, you should be constantly getting yourself updated on the prevailing tax laws, because you may find that the government may levy a tax of 30% this year, next year it could be 32% or 35%. So, they keep on fluctuating. So, you should be very careful about the prevailing tax laws, because this will influence your decision, right. Then in addition to this knowledge on tax structure in your country, you must also find out what are the incentives that is given by the government to the construction companies existing in Ethiopia. In certain countries, government encourages construction companies by providing them certain tax incentive, tax benefit. For this, they may say that okay, if you are buying this equipment, you can claim a rebate or you can claim a discount of maybe 20% or 25%. So, these things also you must be finding out by consulting your local people who are working with construction companies. So, there are two assignments for you. One, find out the prevailing tax laws in Ethiopia. Second, find out what are the tax incentive Ethiopian government is providing to the local construction companies, right. So, these two tasks you please carry out and then discuss with me over email. Now, sometimes depending on the incentive, construction companies take certain advantage of the expenses that they carry out. For example, suppose that government is giving an incentive of buying an excavator which is locally made in, let us say, Ethiopia. Then companies would try to procure that equipment, to purchase that equipment and then get tax benefit. So, what will happen? From the gross income, these admissible expenses will be subtracted. We will see one problem in which it will be more clear. So, from the gross income of the company, you will be subtracting the admissible expenses, and that we will define it as net income. So, net income would be gross income minus admissible expenses. Not all expenses would be given a tax benefit, right. Companies may be spending on so many things, but out of these spendings there are only few items on which the government gives tax incentive. So, it is not that you go on spending whatever you want and get the claim for benefit. No, there are only selective expenses or selective expenditure on which the companies get benefit, and these admissible expenses only get subtracted from the gross income, and then you get net income, and on the net income you pay taxes depending on the tax laws. For our example, we may consider between 35% to 40%. So, that means out of this net income, 35 to 40% would go to government towards paying taxes, and that would be your profit after taxes. So, in all our previous discussions, we had not considered these aspects. So, we were only concerned about the gross profit or gross income, whereas in real life situation you will find that certain expenses are admissible for tax benefit, that is number one, and you have to draw the post tax cash flow diagram to compare the two alternatives or more than two alternatives. So, in this class we distinguish between pre-tax cash flow and post-tax cash flow. Pre-tax cash flow and post-tax cash flow. I will show you how to calculate post-tax cash flow, and this post-tax cash flow would be the basis for our evaluation of alternatives. We can apply present worth, future worth, annual cost method, internal rate of return method or incremental rate of return method on this post tax cash flow diagram. So, we will be forgetting about pre-tax cash flow diagram, because in real life situation we have to deal with these taxes and other expenses, and that is why we will be concentrating only on post tax cash flow diagram here afterwards, I mean here onwards, right. Now, just to illustrate you this concept, I have taken a very small example. In this, I have assumed that there are two companies A and B. A and B, let us assume that they are two construction companies, and their gross earnings or gross income both is, let us say, rupees 150. It could be 150 million, 150 billion, whatever it is. Just assume that 150 is the gross income for both these companies, right. Now, let us say for one company, the admissible expenses, that means those expenses on which government gives certain incentive. So, for one company, that is for company A, let us say it is 50 rupees, and for company B, let us assume that it is 25 rupees. So, what would be the pre-tax profit for company A? It would be 150 minus 50, that means 100 rupees. For company B, it would be 150 minus 25, 125, right. Now, let us assume that tax rate is 40% on your net income. It could be different in your country. So, just you find it out what is the tax rate in your country, right. I have assumed that 40% is the tax rate. So, how much money will go in tax? 40% of net income or 40% of pre-tax profits. So, for company A, 40 rupees will go towards taxes, while for company B, only 50 rupees will go towards taxes. 40% of 125 is 50. So, what is the net profit of company A? It is 60 rupees, whereas for company B it is 75 rupees. So, did you understand this implication of taxes? Both companies have earned the same money. However, the net profit, that means profit after taxes, company A is enjoying 60 rupees, whereas for company B it is 75 rupees. So, this is where difference lies, and that is why it is very, very important to know what is the tax rule prevailing in the country and what expenses are admissible for this tax incentive. These two aspects are very, very important. Now, depreciation is one of the expenses which most of the governments consider for providing incentive. That means, whatever depreciation comes for a particular asset, that is deducted from the gross income, right. Now, this depreciation is a special kind of expense. This is one expense in which money is not physically moving out of your pocket. So, this is expense in a technical sense, but it is not a real expense. That means, money is physically not going out of your pocket. So, you must understand this basic difference. I will give you one more example through which it will be very clear to you what I mean by calling this as a technical expense, which governments consider for giving you the tax benefit. Now, in one of the courses you must have already studied about this depreciation. So, I will quickly run through this particular topic so that it helps us in our discussion. Now, depreciation of assets is on account of obsolescence, or it could be on account of loss of functionality, right. So, what is happening is your asset is gradually reducing in its value. Suppose I purchased a truck in rupees 500,000 today. Now, it is a common knowledge that I will not be getting the same rupees 500,000 after I sell it at the end of 1 year. I may not be getting the full price. So, what has been done? The equipment or the truck has lost its value due to wear and tear, due to obsolescence, due to loss in functionality, and on so many accounts. So, this is the concept behind depreciation, that an asset is losing in its value over a period of time on account of obsolescence, wear and tear, and loss in functionality. Now, this loss in value over a period of time is calculated using different means. So, we will have a quick discussion on the ways through which you calculate the depreciation. I am sure you have already been told about this. So, if you see this particular slide, this shows you different methods which are quite commonly used for calculating the depreciation. Now, why we are studying depreciation here? Because this is also a kind of an expense on which governments give tax incentive. That is the reason we are studying depreciation now. So, we have got straight line method, we have got sum of years digit method, we have got declining balance method, and there are accelerated recovery system which are quite popular in countries such as USA and other countries. And then in addition to this, there are certain other methods also, but we will be focusing only on the first three: straight line method, sum of years digit method, and declining balance method. These three are quite commonly known and quite commonly used depreciation methods. So, all these three methods I will try to illustrate you through a small example. Now, in this particular example, I have assumed that I purchase a equipment for rupees 200,000. Let us say I purchase a equipment for rupees 200,000 and its accounting life, let us assume to be 5 years. Equipment has costed me rupees 200,000 and its accounting life is 5 years, right. Let us assume that at the end of year 5, after selling this particular piece of equipment, I will be getting 50,000. That means, salvage value for this equipment at the end of year 5, let us assume to be rupees 50,000. So, what will happen? This 200,000 value now will be reduced to 50,000 value at the end of year 5. So, every year how much it is losing in its value? Basically, that is the purpose of using these methods. We want to know how much would be the value of this particular piece of equipment after 1 year, after 2 year, after 3 year, after 4 year, and at the end of year 5. So, different methods of depreciation will be giving me different values for this particular equipment at the end of different time periods. If I am using a straight line method, what will happen? 200,000 value now will be reduced to 50,000 at the end of year 5. So, what is the total loss in value? It would be 200,000 minus 50,000. That means equipment is losing 150,000 value in 5 years. Now, straight line method assumes that every year the depreciation is uniform. So, first year how much would it be? 150,000 divided by 5. Second year also the same value, third year also the same, fourth year also it would be same, and finally fifth year also it would be same. That means every year the equipment is losing its value by the same amount. And how much that amount would be equal to? It would be equal to 200,000 minus 50,000 divided by 5. That means 150,000 divided by 5. That means every year the equipment is losing its value by 30,000. So, what would be the equipment's value at the end of year 1? It would be 200,000 minus 30,000. It would be equal to 170,000. That is what you can see in the last column, third row. It is shown book value at the end of year 1 would be 170,000. What would be the book value at the end of year 2? 170,000 minus 30,000. It would be equal to 140,000. Next year 140 minus 30,000. It would be 110,000. At the end of year 4, 110 minus 30,000, it would be 80,000. Next year, that is the last year, it would be 80,000 minus 30,000 divided, that is equal to 50,000. And this is what is salvage value. So, what has happened? Equipment has lost its value from 200,000 to 50,000 at the end of year 5. So, this is the way we use a straight line method of depreciation. So, every year the depreciation is uniform and it is given by the original value minus the salvage value divided by number of years. So, as a formula also you can write it like original value. Now, these values are also sometimes referred to as book value. What do these construction companies follow? They have a accounting book for each of their assets. So, for each of their assets, they will be writing at what price they had purchased this equipment. That price is referred to as original book value. Now, every year depending on how much depreciation has taken place, they will be writing down the revised book value. So, every year it will be changing, and finally, once the accounting life is done or it is over, they will see how much money it is going to fetch if the equipment is sold, that is salvage value. So, for each of the major equipment, each of the major assets which is undergoing depreciation, they will be writing or they will be maintaining these book values, right. That is why you can see in this particular slide I have used the term opening book value. Similarly, fourth column I have used closing book value. So, opening book value for 0th year would be 200,000, at the end of year 1 it would be 170,000, at the end of year 2 it would be 140, at the end of year 3 it would be 110,000, at the end of year 4 it would be 80,000, and finally at the end of year 5 it would be 50,000. So, this is the concept of straight line method of depreciation. Now, same example I will try to do it using sum of years digit method. So, if you see this particular slide, this is showing you the calculation of depreciation using sum of years digit method. So, number of years in our example is 5. So, what would be the sum of years? It would be 1 plus 2 plus 3 plus 4 plus 5, which would be equal to 15. So, sum of years is 15 here, right. So, the first year depreciation would be at a rate of 5 by 15. Second year the rate of depreciation would be 4 by 15. Third year the rate of depreciation would be 3 by 15. Fourth year it would be 2 by 15, and finally at the fifth year, in the fifth year it is 1 by 15. So, if you just try to compare this with a straight line depreciation, you will find that the rate of depreciation here is not constant, which is unlike a straight line method of depreciation. Every year rate is coming down. In the beginning the rate is quite high, 5 by 15, right. Second year 4 by 15, it has come down. Third year 3 by 15, fourth year 2 by 15, and finally fifth year it is 1 by 15. So, this is the difference between a straight line method and sum of years digit method. Now, once you know this rate of depreciation, you have to simply multiply with this with original value minus salvage value. So, 200,000 was my original value and 50,000 is my salvage value. So, the difference is 150,000. So, this 5 by 15 I will multiply it with 150,000. This value will give me the depreciation value for that particular year. So, what I have to do? Rate of depreciation I have to multiply it with the difference of original book value minus the salvage value. So, 150,000 into 5 by 15, how much it would be? It would be 50,000. So, the closing book value at the end of year 1 would be 200,000 minus 50,000, which would be equal to 150,000. Is it clear, technology class? Okay, so similarly for year 2, 4 by 15 into 150,000, it is 40,000. So, the book value would be 150 minus 40, 110,000. Third year it would be 110 minus 30, 80,000. Likewise, at the end of year 5 it is showing you 50,000. Now, the second last column, please make a note. First year the depreciation is the maximum. It is coming to be 50,000. Second year it has come down, it is 40,000. Third year it is 30,000. Second year it is 20,000, and finally fifth year it is 10,000. Now, if you sum it up, you will find the sum to be equal to 150,000. this sum is same as straight line method of depreciation sum. So, what is the difference? Difference is the timing. Whereas in a straight line, every year the depreciation amount was 30,000. Whereas in sum of years, what you find? First year it is very high, second year still high, means slightly lower than the first year, and at the end the depreciation amount is very low. So, this point you make note of, that in sum of years, in initial years the depreciation is quite high, and towards the end depreciation reduces, but the total sum remains same. Total depreciation will be 150,000 only, but the timing changes, and this timing companies try to take advantage. So, there is a conflict between government and the companies. That aspect we will discuss little later. Now, we will show you how to calculate depreciation using double declining balance method. There are many types of declining balance method. You have single declining balance method, you have 1.5 declining balance method, and the most commonly used method is double declining balance method. So, these are three most commonly used declining balance method types: single declining balance method, 1.5 declining balance method, and double declining balance method. This particular problem I have tried to solve it using double declining balance method. Now, in double declining balance method, as the name suggests, the rate of depreciation is 2 by n, 2 divided by n, where n is number of years or accounting life. So, in our example, I have assumed an accounting life of 5 years for this particular problem. So, the rate of depreciation would be 2 by 5, 2 divided by 5, which would be 0.4. So, this rate also here is constant, 0.4. But there is one more difference in this particular method. This particular method does not take salvage value into consideration. It considers only the original book value or the opening book value, right. So, for year 1, 0.4 would be multiplied with the original book value, which is 200,000. So, the depreciation for year 1 would be 200,000 multiplied by 0.4, which would be equal to 80,000. So, at the end of year 1, your closing book value would be 200,000 minus 80,000, that would be equal to 120,000. $120,000 would be the closing book value at the end of year 1. Now, this 120,000 will be further multiplied by 0.4 to get the depreciation for the year 2. So, it would be equal to 120,000 multiplied by 0.4, which would be 48,000. So, what would be the closing book value for year 2? It would be 120,000 minus 48,000, which would be equal to 78,000. Sorry, 72,000. Now, again for depreciation calculation at the for year 3, this 72,000 will be multiplied with 0.4. So, the value is 28,800. So, what would be the book value for year 3, closing book value? It would be 72,000 minus 28,800, which is coming to be 43,200. But this value cannot go below 50,000. Why? Because you are able to sell that equipment at 50,000. Salvage value is 50,000. So, the book value cannot go below this 50,000. So, here even though we are getting a book value of 43,200, you have to take 50,000 as the closing book value, right. So, in year 3 itself we have reached the salvage value, that is equal to 50,000. So, end of so for the month for year 4 and year 5, depreciation would be 0. So, that your book value in year 4 and in year 5 remain at 50,000 only. Is it clear, technology class? Fine. So, this is how we calculate depreciation using double declining balance method. Now, here you can make one more note. The double declining balance method is giving you the maximum depreciation in initial years. You have got 80,000 in year 1 itself. So, this is one of the fastest method of depreciation. If you try to compare all the 3 alternatives using a straight line method, we got a depreciation value of 30,000 for year 1. Using sum of years, how much did we get? 50,000. And during using double declining balance method, we got a value of 80,000. Now, this is where the conflict lies. Construction companies would like to take fastest method of depreciation, whereas government would like to go for as low value of depreciation in initial years as possible. So, there is always a fight between business houses and government. You will notice that the amount of depreciation calculated remains same in all the 3 methods. It will be equal to 150,000, but their timing is different. First one is constant throughout the life of the equipment, second one is faster, and third one, double declining balance method, was the fastest. Now, while at depreciation, I will like to tell you about switchover point. This switchover point comes into picture when you are dealing with the asset which has got a very long life. Let us say 10 years, 15 years, 20 years. Suppose some equipment is lasting for 15 years or 20 years. If you try to calculate depreciation using double declining balance method, you will find that in the beginning years depreciation would be high, but during latter part depreciation would be quite small, quite low, and you will never be able to achieve the salvage value. So, government agencies allow a switchover point. This switchover point basically tells you to switch the method from double declining to any other method, so that at the end of its accounting life you are able to get a salvage value. Now, there are ways how to calculate or how to locate the switchover point, but those aspects I am not covering in detail here. You can refer to any of the textbook and you will come to know about switchover points. Normally, switchover point is located at that location at which the depreciation value calculated using double declining balance method is lower than that calculated using either the straight line method or the sum of years digit method. And this is allowed by most of the governments. So, switchover point or switchover point concept is recommended by most of the governments, so that companies do get advantages. So, that you can refer to any of the textbook which I have given you a list, and then you can understand on your own. Now, if you just look at this particular graph, it is showing you the rate at which the equipment is losing its value over a period of time. The first line, the topmost line, if you see, that is calculated using a straight line method. If you see, the equipment has been bought at rupees 200,000, and at the end of year 5 it is at a value of 50,000. So, all the three methods are taking you at the same point. In a straight line method, you are gradually reaching there. Every year you are accounting for equal depreciation. The second method is using sum of years digit method. You find that in the beginning years it is faster than a straight line method, and the lowest line, if you see, lowest curve if you see, you find that this is giving you the highest depreciation in initial years. Slope is very steep in initial years, and then the slope becomes almost horizontal from year 3 onwards. This is because there is zero depreciation for year 4 and for year 5. So, this is just to show you a graphical representation of all the three methods. Is it clear, technology class? Okay. Now, we will see the impact of depreciation and tax on selection of alternative. Till now you have got exposed to depreciation and taxes. Now, we will see how do they really impact your decision. You will find that in some of the cases, if you do not consider depreciation and taxes, you may arrive at a particular decision, whereas if you take these into consideration, sometimes your decision may be reversed. So, this is the reason we are studying the impact of depreciation and taxes on selection of alternatives. For this, I have assumed that there are two equipments available to carry out a particular function. Let us say there is one equipment A and there is another equipment B. You can note it down. Initial cost of equipment A is 12.5 lakhs. 1 lakh is 100,000, right? initial cost for equipment A is, if you see the slide, equipment A is costing you 12.5 lakhs, equipment B is costing you 7.5 lakhs. Just note down from the slide. The operating cost for equipment A is 3 lakhs every year. For equipment B, it is 5.5 lakhs. Economic life for equipment A is 5 years, and for equipment B also it is 5 years. Corporate tax or the income tax, just to simplify this, I have assumed to be 50% in both the cases. And salvage value I have assumed to be 0 for both the equipments. Salvage value I have assumed to be 0 for both the equipments. Now, based on these information, can you tell me which equipment to buy? Whether to buy equipment A or whether to buy equipment B? So, for this, step 1 as usual is to draw the cash flow diagram. The cash flow diagram would be pre-tax cash flow diagram first, and then we will see how to draw the post-tax cash flow diagram. So, please draw the pre-tax cash flow diagram for equipment A and equipment B. I will show you how it is done in a step-by-step manner. If you see this, let us assume that first I have to draw the cash flow diagram for equipment A. It is given that it is costing 12.5 lakhs. So, 12.5 lakhs initial cost, that means at time t is equal to 0. Operating cost every year is 3 lakhs. So, 3 and 3 lakhs. This is year 1, year 2, year 3, year 4 and year 5. All these are in lakhs. 3 lakhs, I will write L. L means lakhs, let us assume, right. So, till here there is no problem. This diagram I call this as pre-tax cash flow diagram. For equipment A. Any doubt here till here? Now, I will show you how, any doubt? Okay, now I will show you how to draw the post-tax cash flow diagram for this. For this, let us assume that I am following a straight line method of depreciation, SL method of depreciation. So, what would be the depreciation every year? Depreciation would be constant every year. It would be equal to 12.5 minus 0. 0 is what? Salvage value. It is given to be 0 divided by 5. 5 is what? Number of years. Its useful life, accounting life, 5 years. So, what would be the depreciation value? 2.5 lakhs L. This is depreciation. What is the expense every year operating expense is, operating cost is given to be 3 lakhs, 3.0 lakhs. So, what would be total expense? $3.5 lakhs, sorry 5.5, 5.5 lakhs. Now, tax is given to be 50%, tax at a rate of 50%. So, 50% of 5.5 lakhs which will be equal to 2.75 lakhs So, what would be the net operating cost? Net operating cost would be equal to 3.0 minus 2.75, which would be equal to 0.25 lakhs. So, how will my post tax cash flow look like? It would be equal to something like this. I have 12.5 lakh here, 0.25, 0.25, 0.25, 0.25 and finally 0.25 here. This is year 1, 2, 3, 4, 5 and this is 0. This is my post tax cash flow for equipment A. I will give you 1 or 2 more examples. Even if you do not understand this very clearly, it does not matter. I will give you 1 or 2 more examples, it will be more clearer then. So, what has happened is post tax cash flow diagram is giving me a net operating cost of 0.25 lakhs only every year for next 5 years. Whereas, if I would not have taken this depreciation and other admissible tax expenses into consideration, I was getting a figure of rupees 3 lakhs every year for next 5 years. Now, if you see this particular, I have done all these calculations in this particular slide also. This is how it looks like. How I have done the calculation. Operating cost is 300,000, that is given every year 3 lakhs. Depreciation using a straight line method I have found to be 250,000, 2.5 lakhs. How I have calculated depreciation? 12.5 lakhs, that is 50,000 minus 0 divided by 5. So, the total taxable amount becomes 300,000 plus 250,000, that is 550,000. Now, corporate tax would be levied at 50%. So, the total tax would be 275,000. So, company is effectively having a net cost of 25,000 only. Now, you must be wondering why I have subtracted this tax from the operating cost. This is because this will be more clear when I deal with the situation in which income is given, because that time it will be more appealing to you. Here what you can understand is the taxes are at the rate of 50% of the total cost, that is 550,000. So, company is getting a benefit of this much tax, and that is why it has subtracted it from total cost. Do not worry, even if you do not understand till this point, it will be more clear in second example. Do not worry. The same exercise you can do it for equipment B also, like this. Just try to work it out for equipment B. For equipment B, the operating cost every year is 5.5 lakhs, which is 550,000. Depreciation would be how much? You have bought the equipment at 7.5 lakhs, which is 750,000 minus 0 divided by 5. So, depreciation would be 150,000. So, the total expense is how much? 550,000 plus 150,000. But remember, this 150,000 depreciation is not going out of your pocket. It is only for calculating the tax benefit. Money does not flow as far as depreciation is concerned. It is just technical in nature, right? So, the total taxable amount is 700,000. Total taxable amount is 700,000. Now, corporate tax, let us say I have assumed to be 50%. So, the tax benefit that the company would be getting is 350,000. So, what would be your net cost per annum? It would be 550,000 minus 350,000, which would be equal to 200,000. And you can draw the cash flow diagram, which would be something like this. For equipment B, you got it at 7.5 lakhs, and every year now you are paying 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs and 2 lakhs. This is the post tax cash flow diagram of equipment B. So, now both the cash flow diagram of equipment A and equipment B is known to you. Now, you can use any of the methods like present worth method, future worth method, annual cost method, or rate of return method, or incremental rate of return method to decide which alternative is the best. You can work it out from here. Okay, I have also done the solution for this. You can just have a cross check. If you just see this particular slide, in this particular slide I have used present worth method. Once you have got both the cash flow diagrams, it is very easy to do the analysis. The net present worth of equipment A would be minus 13.45 lakhs. Minus 13.45 lakhs. You can do this calculation on your own and check it. Similarly, the net present worth of equipment B would be minus 15.08 lakhs. Minus sign because they are all cost. So, which equipment you will choose? Equipment A, because it is costing you less. For equipment A, the net present worth is working out to be minus 13.45 lakhs. For equipment B, it is costing to be minus 15.08 lakhs. Hence, we are choosing equipment A as its net present worth is more. In other words, it costs less. So, this is as far as evaluation using present worth method is concerned. Now, same example I have solved using annual worth method also. You can have a look at this calculation. Annual worth of equipment A is equal to minus 12.5. Remember, all these calculations are based on post-tax cash flow diagram. We are no longer utilizing pre-tax cash flow diagram. So, annual worth of equipment A is minus 3.55 lakhs. For B, it is minus 3.98 lakhs. Hence, using this method also, we are selecting the equipment A as it is costing me lesser. Now, can you use incremental rate of return method for solving this? You have got two cash flow diagrams, both of cost dominated cash flow diagram. So, using that, we can convert it into a mixed kind of a cash flow diagram, and we can apply incremental rate of return method to solve it. I will show you how it is done. First, I will draw the cash flow diagram on incremental basis. So, just have a look at both the post-tax cash flow diagrams and try to make the additional cash flow diagram on incremental basis. So, just have a look at this. At time t is equal to 0, I am investing 5 lakh more in option A. So, here I will write A over B. That means, if I am choosing A over B at time t is equal to 0, how much extra money I am putting? 12.5 minus 7.5, which is 5 lakhs. And this 5 lakh, what is the benefit that I am getting? At the end of year 1, I am getting a return of 1.75 lakhs. How this 1.75 lakhs? This is nothing but 2 minus 0.25. That means, if I am spending 5 lakhs extra now, I am getting an extra benefit of 1.75 in year 1, 1.75 in year 2, 1.75 in year 3, 1.75 in year 4 and 1.75 in year 5 also. So, this is the cash flow diagram on incremental basis. Is it clear, technology class? Okay, good. Now, once you have got this diagram with you, you can find out its rate of return. I have done it for you, you can cross check. If you just see this particular slide, to start the calculation, I have assumed a trial value of 10%. I am getting a net present worth of 1.633. Since it is positive, I have increased the I value to 20%. I am getting a net present worth of 0.233 lakhs now. So, what I will do? I will further increase the I value. So, what I value I will assume? Let us assume I is equal to 25% now. For I is equal to 25%, I am getting a net present worth of minus 0.294 lakhs. So, the transition from plus net present worth to minus net present worth has been made between 20% to 25%. So, by interpolating, we are getting an I value of 21.53%. Now, since this is more than 10% MARR, we will prefer equipment A. So, what we find here is that all the three methods, when analyzed with the help of post tax cash flow diagram, are giving you the same decision, that is to go for equipment A. That is to choose equipment A out of the two equipments A and B. So, if I just try to summarize whatever analysis process I have adopted here, step 1 is to draw the pre-tax cash flow diagram of all the alternatives. Then, depending on the original cost, initial cost and salvage value and its life, you can calculate the depreciation for each of the year. In this case, I did the calculation only once. Why? Because I had used a straight line method of depreciation. If I were to use other methods of depreciation, every year I have to perform this calculation in order to draw the post tax cash flow diagram. So, in next example, what I have done is, I have taken three methods of depreciation and I have taken three cases. One, when the income information is given, and then there are two more cases which we will see. So, I will just try to take you to another example in which income is given. That means, income of the company is given. For this, you just try to note down this particular problem quickly. I am assuming that equipment has been purchased for rupees 3.5 lakhs and its accounting life and service life happens to be 5 years. So, its life is 5 years. The salvage value is nil, that is 0. So, three information in this particular statement. You have purchased the equipment for 3.5 lakhs, life is 5 years for the equipment and its salvage value is 0. Second statement, the gross income for all the 5 years is assumed to be rupees 2.5 lakhs. That means, by operating this particular piece of equipment, you are earning 2.5 lakhs every year. And let us assume hypothetically that we are not spending anything. So, the expenses are assumed to be nil. So, that means income alone is given to me and I am not spending anything. It is just a hypothetical example, because in order to make income you have to invest some money every year, but for time being I have assumed it to be 0. Based on this information, can you draw the pre-tax cash flow diagram? You have purchased the equipment for 3.5 lakhs, equipment will last for 5 years, salvage value is 0 and you are earning 2.5 lakhs every year for next 5 years and expenses are 0 throughout the life of the equipment. So, can you just draw the pre-tax cash flow diagram based on this information? I will also try to help you out. I have purchased this equipment for 3.5 lakhs. So, I write it here at T is equal to 0. Now, year 1, year 2, year 3, year 4, year 5. Year 1 I am making an income of 2.5 lakhs, 2.5 lakhs, 2.5 lakhs, 2.5 lakhs and finally 2.5 lakhs. Life is 5 years. This is year 0, 1, 2, 3, 4, 5. I am not showing anything in negative side for year 1, 2, 3, 4 and 5 because expenses are 0. This is the pre-tax cash flow diagram for this particular problem. Now, I have to draw the post-tax cash flow diagram, and for this I will be using all the 3 methods of depreciation. In case 1 I will use a straight line SL method, in case 2 I will use sum of years digit method, in case 3 I will use double declining balance method DDB. So, using all these 3 cases I am going to work out the post tax cash flow diagram. Now, using a straight line method, how do I calculate? What would be the depreciation every year? Depreciation would be, for all the year it is going to be same. It is going to be 3.5 minus what? 0, because salvage value is nil. So, minus 0 divided by 5. So, it is equal to 0.7 lakhs. This is clear. Every year we have to incur, we have a depreciation of 0.7. Okay. So, how do I calculate the post-tax cash flow diagram? For that, I will write it like this: income is, this is for year 1 I am making, year 1. Income is 2.5 lakhs. Under expense, what we have? Depreciation is equal to 0.7 lakhs. Other expense 0. It is 0. So, what is the total expense? It is equal to 0.7 plus 0, which is 0.7 lakhs, right? 0.7 lakhs. Now let us assume that tax rate is, how much we should assume? 1 point. Okay, let us assume 50%, let us assume, to make the calculation simple. Tax at a rate 50%. So, what would be the total tax? Before this you can add a row, net income. It would be 2.5 minus 0.7, which will be equal to 1.8 lakhs. And tax rate, let us take 40%. So, 40% of 1.8 lakhs is equal to 0.72 lakhs. So, what is your income after tax? What is your income after tax? It would be equal to 2.5 minus 0.72, which would be equal to 1.78 lakhs. It would be equal to 2.5 minus 0.72, which is equal to 1.78 lakhs. Is it clear to you now? How I have calculated this after tax, is it clear to you now?
Why don't we deduct from the net income?
Because these are the expenses which are admissible for incentive tax benefit. I told you that there are certain expenses which are given tax incentive. So, depreciation is one of the expenses on which government gives you tax benefit. So, I have calculated a depreciation of 0.7 lakhs, other expenses are 0. So, my total expense is 0.7 lakhs. So, this expense is admissible for tax benefit. So, that is why I have deducted this from my gross income. Although this money is not the real expense, but government is giving me incentive. And that way I have deducted 0.7 from 2.5. So, I am getting 1.8 lakhs, and now government will charge the taxes only on this 1.8 lakhs. Right. So, this is how we work it out. Now, using this particular method, you can work it out the post-tax cash flow diagram. Post-tax cash flow diagram, this is using a straight line method. Now, similar calculation you can perform it using sum of years digit method and double declining balance method, and then you will be understanding the implication of depreciation and taxes on your decision making. So, I think at this point itself I will have to stop, and if you have got any doubt, we will be taking those queries shortly. Thank you. Yes. Yeah, please.